Another new record high yesterday, and futures are up this morning. 30 minutes until the start of the cash trade. I'm Matt Miller. Dani Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, Xi presses Trump on Taiwan, warning of potential clashes if the issue is mismanaged. The issue of Taiwan, very key here. Also, tech key in this summit. The rally continues as Cisco soars on a strong forecast and AI-focused restructuring plan. They're doing better, so they're going to fire 5% of their workers. Plus, the biggest IPO of the year, AI chipmaker Cerebras raises $5.5 billion in its offering, but the market cap is still less than 1% of Nvidia. In terms of the stocks that we're watching this morning, Cisco ripping on that earnings report, up 16% in the pre-market. It boosted its full-year forecast. It announced job cuts to focus more on AI. Reuters is reporting that the U.S. has cleared around 10 Chinese companies to buy Nvidia's H200 AI chips. Remember, President Trump made an exception for the H200 chips, but the Chinese companies weren't buying. Maybe they will after this meeting. And Morgan Stanley issued a bullish call on Ford, saying the automaker's energy storage business could make a deal with hyperscalers soon. You don't see that reflected in today's shares, but yesterday they rallied 13% in their biggest gain since March of 2020. Now, Presidents Trump and Xi wrapping up the first day of their summit in Beijing with trade, Iran, and Taiwan all in focus. Xi said the talks laid out a vision for stable ties with the U.S., while Trump said relations would be better than ever.
The relationship between China and the USA is going to be better than ever before. Tonight, it is my honor to extend an invitation to you and Madam Peng to visit us at the White House this September 24th.
China and the United States both stand to gain from cooperation and lose from confrontation. We should be partners, not rivals. We should help each other succeed and prosper together.
After those kind words from President Trump, President Xi warned the U.S. the Taiwan issue must be handled with extreme caution and could lead to conflict if mishandled. Joining us now from Beijing is Anne-Marie Jourdain, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. So, President Trump very happy to be there. It's a great honor for him. But President Xi was pretty harsh out of the gate.
Yeah, well, out of the gate, when it comes to the bilateral meeting, after they had this very warm welcome, and I was there for that outside the Great Hall of the People, out of the gate, President Xi Jinping asked this question about really the competition between the world's two biggest economies, likening this to the Sidious trap, which basically means could an emerging power continue to emerge without conflict of an already existing great power? That was the question he started out in terms of the bilateral meeting. And as the meeting took place, and it went for about 2.5 hours, why Taiwan is really the big subject matter is because while the meeting took place, China media pushed out a readout from Xi Jinping saying that he brought up the issue of Taiwan, saying it was the most important issue in China-U.S. relationships, and it's mishandled. It can bring this relationship to a dangerous place. Now, it's not unusual that a Chinese president would bring up the issue of Taiwan, but it is interesting that it was brought up in a readout while the two were still in the bilateral meeting, and then hours later, when we received the White House readout, Taiwan was not mentioned at all.
It is fascinating. What about Iran, Anne-Marie? Because there had been some communication that the U.S. wouldn't be asking China's help on Iran. And then I saw comments from Marco Rubio on the plane that indeed that would be part of this discussion.
Well, Iran was definitely part of the discussion, according to the White House readout of how the bilateral meeting went. In terms of how the United States saw it, is that Xi Jinping expressed his displeasure with the militarization of the Strait of Hormuz, as well as he doesn't want to see a toll when it comes to ships passing through the Strait of Hormuz or attempting to pass through the Strait of Hormuz, and that the two agreed that Iran cannot have a nuclear weapon. Clearly, China, though, is the biggest revenue driver for this regime. They buy the lion's share of Iranian oil. They recently told a number of firms that they can ignore the sanctions when it comes to buying Iranian crude. So clearly they have at least some indirect power here, or direct power in terms of money, in terms of their influence on Iran. So that was telling that this was in the White House readout as well. Really, the national security geopolitical concerns is what is making a lot of headlines. But one thing that was also very clear to me from the White House readout is that this administration wanted to really focus on the deals. And already, I think, in a sign of goodwill, you have seen China have new licenses, import licenses, renew them to buy U.S. agricultural products like beef. They have another day of meetings tomorrow. Potentially, we're going to get more clarity, a number of issues, like when it comes to chips. Individuals like Elon Musk and Jensen Huang are here. I know there's a lot of anticipation, potentially. Reuters had a report about Nvidia chips that the United States is saying that they can sell into China. Well, that already was an issue that was resolved in January on the U.S. side. The big question is China going to allow firms to actually buy them?
All right, Anne-Marie, great to get you on the program. Looking forward to your interview with U.S. Trade Rep Jamieson Greer later on tonight. Anne-Marie Horton there in Beijing. Now, speaking of trade, Nvidia CEO Jensen Huang says the meetings in China went excellent. He spoke with Bloomberg's Colin Murphy in Beijing.
One of the most important summits in human history. And the two presidents, President Xi and President Trump, have such a wonderful relationship. This is an incredible opportunity for us to rely on the relationships to build a much, much better partnership.
Did you get any specific customers for your chips for the H200?
We didn't really talk about. I'm here to support the president and to represent the United States.
Those comments coming as Reuters reports that the U.S. has cleared around 10 Chinese companies to buy Nvidia's H200 chips. Treasury Secretary Scott Bessent saying he is not aware of any new approvals for Nvidia. Let's get more at Bloomberg Tech's Ed Ludlow. So, Ed, this is a pretty murky situation, right? And I know that the U.S. has already given Nvidia clearance to sell some chips as long as it kicks back a certain percentage of that revenue to the government. Are there buyers for these chips?
Murky on the China side, right? So throughout this whole period of time where the United States has granted licenses allowing Nvidia to export, technically, those generation of chips, Jensen Huang's always been consistent in saying when we negotiate these, we don't negotiate them with the Chinese government. We don't negotiate them even with any government agency. If China permits that group of companies to buy the H200, then the companies will place orders. And back at GTC, which is Nvidia's own annual developers conference in March, Jensen Huang said on stage that orders have been placed. So this is mostly just an issue of chronology, because whatever comes out of the summit in Beijing, Nvidia reports its fiscal first quarter 27 earnings next Wednesday. And either those orders are material and they'll show up and be disclosed, or they won't.
All right, so we'll see when those earnings are reported. In terms of what we know today, Cisco absolutely knocking the cover off the ball with its revenue forecast, more than $1 billion, stronger than the street had anticipated, and yet they're firing 5% of their workforce. So they're saying we're doing so well that we're going to eliminate thousands of jobs.
I love that expression. I think you mean baseball, right? But I would interpret cricket. Basically, Cisco
There's no cover on a cricket ball.
There is a leather cover on a cricket ball, technically. Let's get to the Cisco print, which is orders of $9 billion just from the hyperscalers. $4 billion of that will convert into revenue that will show up in the income statement this year. And Cisco is proving that it is a part of the AI story. But the reason, not just the 15% gain in pre-market is important, but the sort of feel-good across equity markets this morning, which our markets group, right, in the wrap, credits to the Cisco print, is important, is that Cisco's role in a data center is real. If the orders are placed, it means the data centers are actually being built. It does networking, which in layman's terms is all the cabling, all of the switches, and all of the routers that connect all the rows of servers inside a data center. If Cisco's really ramping up its outlook and saying that we're going to book real revenues from the hyperscalers on this, then all of that capital expenditure that we've been focused on for so long is translating now into projects in the real world. And that's something to certainly pay close attention to through Cisco's lens.
We're paying very close attention to Cerebras today,
Yes.
an IPO. I mean, it is incredible that they had more than 20 times the demand for the shares out. They were going to price them at 150 to 160. Now they're pricing them at 185, right? $5.5 billion, more than that they're raising. So it just sounds amazing. But then you compare it to the leader in the space, Nvidia, and they have less than 1/4% of the revenue of Nvidia.
Yeah, I mean, on a fully diluted basis, a market cap based on where the IPO priced of about $50 billion on a fully diluted basis. They have a big order backlog, around $24 billion. And what you need to know about Cerebras is that it doesn't just do what Nvidia does. It doesn't just provide the sort of compute in the context of the silicon. It does full stack, fully integrated a supercomputer. It takes on the capital burden of the hardware. So how Nvidia works is Nvidia brings the GPU and the other core compute components in the tray. But someone like a Dell would assemble that server for them. Dell has margins in the low teens. Cerebras has margins 40–41%, but it's never going to have margins at the 70% that Nvidia does. What it does have is a system, a completely fully built system that has 21 times performance in terms of dollar per token for inference. That's running the AI model. And so that's the story they've got to convince the market. That they are outperforming Nvidia just on the computer performance basis, and that they can scale and meet the backlog that's there. But you're absolutely right to frame this more of them chipping away at what is an Nvidia monopoly still.
Ed, great roundup there. I look forward to your program. Bloomberg Tech kicks off at 11 o'clock. Ed Ludlow and Caroline Hyde co-hosting. Catch Ed's interview, by the way, with the CEO of Cerebras, Andrew Feldman. That's at 11:30 a.m. New York time. Now, retail sales advanced for a third month in April, pointing to some signs of consumer resilience despite higher gas prices. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent. So, Mike, what do we know about, I mean, obviously gas sales are going to be great. So the dollar number on the headline will be big. But what do we know about the consumer's ability to spend otherwise?
The key point that retail sales are denominated in dollar sales. And so it made a big difference this past month. The consumers are still here, although we're getting more and more categories that saw declines, which is even harder to do when you have dollar inflation. Retail headline in about 0.5% higher, but you take out gasoline, which was up 2.8%, and you get a 0.3 rise. Import prices, which I don't have on here, were up 0.7 without gasoline and petroleum in it. And I just point that out because imported gasoline up by 19%. So gasoline having a big impact on all of this. The retail core, which is what goes into the GDP numbers, up by 0.5%. That's still relatively strong. Jobless claims, no change really, still showing a stability in the labor market. Now, the biggest movers in terms of retail sales, gasoline, as I mentioned, electronics and appliances were up 1.4%. I don't know exactly why. It's not like there was a new iPhone or anything out at this point. But clothing sales down 1.5% and car sales down 0.4%. That's because Matt always just leases his cars.
That is not true. I've never leased a car. I always buy them. Well, I finance them usually. Yeah.
Well, anyway, this all leaves the markets wondering what's going to happen. Obviously, we're seeing the consumer slow down, but jobless claims not up. So what does Kevin Warsh face when he gets in? Markets are still saying he faces interest rate increases. You look at what Fed funds futures are forecasting, and they see nothing but rate increases in the months ahead. Now, those don't mean a lot of different increases, but they are different percentages in terms of things going up. And we want to remind you that Kevin Warsh, when he takes office, kind of still on the clock. Scott Bessent was on CNBC this morning, and he was asked about the president and his patience, and Bessent said, we might get a series, one or two more hot inflation numbers, but then I think we're going to see a substantial disinflation, and then I think he's going to be in a very good position to cut rates. So the administration still has its finger on the rate cut button.
Right. Well, they're pushing for that outcome. The question is whether the economy or the markets will allow it. Mike McKee is our chief policy and economics correspondent. Coming up next, Maria Veitmane of State Street says tech is the only story in the equity market. Tech is Tina. She joins us next. And later this hour, Dani Berger moderates a panel on the AI-powered workforce with the CEO of Bridgewater near Bardea, as well as Cisco's chief people officer, we're still using that term, and Authentic Brand CEO Jamie Salter. They join Dani live from the Global Citizen Now event in New York. This is Bloomberg Open Interest. The NASDAQ 100 set for a third record high since Monday. Maria Veitmane, State Street Global Markets head of equity research, says tech is Tina. Writing, for us, there is only one story in the equity market at the moment. Tech, it is the only sector with strong and predictable earnings growth and margins resilience. Maria joins us now, I'm happy to say. You know, it's a little bit concerning, right? If there's only one sector, if there's only one industry in this market that's reliable, can you still be bullish on stocks through the end of the year?
Yeah, I mean, I have to say we are very bullish. We have been bullish on stocks for a while, exactly for the tech story. It is the largest sector. It is the sector with the strongest earnings, and it's pushing prices higher. And I think it's kind of interesting to understand that there is still plenty of liquidity in the market, and it's just going through a very narrow funnel into the tech sector. No other sector is being bought. No other sector is showing strong kind of earnings growth. No other sector is performing. So it is all the money going into tech sector, and there's still plenty of money, so that's kind of very big support for equity.
Are the other sectors, though, looking particularly weak, the rest of the market? I mean, with the closure of the Strait of Hormuz, with the doubling of oil prices, with the China-Taiwan situation, are we looking through all of that, or is it actually affecting the rest of the companies in the S&P 500?
I mean, I have to say, I drew this chart yesterday, and it really surprised me. If you look at performance by sector, by country, by region since the start of the war, U.S. is up, Korea and Taiwan is up, tech is up, and everything else is barely positive, right? So we have this kind of all stocks making all-time high, MSCI World, NASDAQ, S&P, everything. But actually, under the surface, it just tech that is rallying. Nothing else does. So I think market is not really looking through Strait of Hormuz problem and kind of worsening economic outlook. It just tech strength masks everything else. So I think performance is not that irrational.
At what point, though, do oil prices, does inflation, do higher rates start to come through, or will they have no effect on the tech bull market?
I think tech is probably more resilient than any other sector. So I think you see a lot more underperformance everywhere else before we start seeing tech cracking. But yes, it's not tech is not kind of unbreakable. So there is a set of circumstances when we start worrying. But I think there are lots of other kind of dominoes to fall before we will start worrying about tech in a serious way.
You know, the point has been made, Maria, many times that the U.S. is energy independent to some extent. Obviously, oil is a fungible commodity, so it trades at the same price around the world. But natural gas, for example, that feeds and powers our data centers, we pay less for it than we did before the war. And in Europe, you have a serious problem when it comes to energy. Is that going to affect, the bull market run that Europe showed last year?
No, absolutely. And we were kind of the opinion that European rally was a little bit of a hope trade. So your European stocks, of course, they are they're cheap, they're trading at a big discount, and of course, like profitability was weak. And there was this hope at the end of last year that overall economic growth is improving, and there are fiscal spending coming from European governments that can affect those earnings in Europe, and kind of market try to kind of move away from expensive and wonderful US to cheaper European stocks. And but like what we're seeing now, and particularly with the Strait of Hormuz issue and rising gas and fuel price, very kind of energy-hungry European companies, they are struggling. So profitability in Europe is, I mean, Europe seeing the biggest downgrades of all regions in MSCI World right now. We see very strong institutional investors selling. So it kind of makes sense that this kind of the rotation out of Europe and actually the rest of the world into US, that's really what we're observing in our data set.
All right, Marija, great to get some time with you. Really appreciate it. Marija Veitmane there of State Street saying tech is Tina right now, but that doesn't dissuade her from continuing bullish sentiment on the broader market. Next hour, we get an interview with the CEO of Invesco, Andrew Schlossberg. We'll get his take when he sits down with our own Katie Greifeld at the firm's New York headquarters on what comes next for the asset manager as we look at futures higher again after yet another record high for the S&P 500, for the Nasdaq 100. The bullish sentiment continues as President Trump meets with President Xi in China. You can see S&P futures up 0.2%. Nasdaq futures just barely up, but the small caps gaining as well. And we're not looking at such strong rates either. 441 on the 10-year right now as we see the price of oil, Brent crude, holding at $105 a barrel, NYMEX just over 100. We are going to bring you the opening bell in just 6 minutes' time. This is Bloomberg. Take a look at some of the movers this morning. StubHub reported better than expected first quarter results, reiterated its annual forecast, and the shares are soaring. Viking also delivered revenue that beat and announced a C-suite shakeup, and those shares are up 9%. Klarna posted a small profit as it looks to diversify its funding sources. Also a big gainer, the opening bell on the other side of this break. After an all-new record close yesterday, we're looking at higher futures this morning. The trade is just about to start. This is Bloomberg Open Interest. I'm Matt Miller. You can see S&P futures up. NASDAQ futures not really moving so much higher right now, even though the story today is tech. It's Cerebras. It's Cisco. It's Ford, which is an AI story as well. It's Blackstone Digital Infrastructure Trust. They're ringing the opening bell at the New York Stock Exchange. That is a big dude, and it's a big day for them as they IPO that. Down at the NASDAQ market site, you've got the AI darling of the hour, Cerebras, ringing the opening bell, 20 times oversubscribed in their IPO. They were looking to price shares at 150 to 160. They went to 185. They're raising $5.5 billion. So it's all about tech today. Cisco is another big story after coming out with earnings that beat and a revenue forecast for the quarter that was $1 billion more than the street was expecting. They're also going to fire thousands of people, reduce their workforce by about 5% because they're doing so well. As a result, the shares are up 13%. Nvidia shares up 2.33%. Reuters reporting on Nvidia that the U.S. has cleared around 10 Chinese companies to buy Nvidia's H200 AI chips, but the U.S. has already made an exception for H200 sales to China, as long as they kick back a certain portion of that revenue to the U.S. government. Let's talk about all this tech madness with Stephanie Aliaga, JPMorgan Asset Management Global Market Strategist. She joins me here at the desk. Stephanie, great to have you on a day when there's like nothing else but AI, and I think it's really representative of this market. It doesn't matter that oil is twice as much as it was a couple of months ago. It doesn't matter that rates are higher. It doesn't matter what the Fed does, as Kevin Warsh is confirmed chairman. All that matters is this AI capex story.
And it's true that the economy is a lot soggier this year for a variety of those reasons. There are still these headwinds, but we just have this AI rocket ship strapped to our back that is getting us through all of that, at least when it comes to what matters for earnings. And if we think about what has changed this year around AI, 2026 is going to go into the history books as the year of agentic AI, the year that the compute math was just completely rewritten. And we are in the midst of a market where the demand for AI is just accelerating. It's hitting this wall, and the supply of it cannot nearly catch up quite as fast. But I think what is really fascinating, particularly this year relative to like 2023, when we were first talking about chip makers like Nvidia, is that the market for picks and shovels does continue to evolve. And standard economics, what happens when you have high prices and hot demand? You invite newcomers. You invite different parts of the ecosystem to come in. So we've had these legacy chip makers getting a second life, right? You've had all this demand extend overseas. Korea, Taiwan just continue to be in the focus point. So I think this AI wave, like, it still remains concentrated in the broad sense of it all, but it has broadened out. And the reality is, even if the charts of some of these stocks almost look like meme stocks, the exceptionalism is in earnings, not just in runaway multiples, and that is just something that we really do not see quite often.
Yeah, you don't actually see runaway multiples, right? We were marveling over the fact yesterday that Micron was only trading at 8 times forecast earnings. I mean, that's just nuts, considering the chart is absolutely hyperbolic. Are we moving past kind of the boom-bust cycle? Are we moving out of, is this more than just a demand shock and maybe a change in the long-term run rate of growth?
Yeah, I think the reality is these chip companies have always been very cyclical in nature, right? Very tied to overall growth. But we're seeing that break down a bit now that you have structural demand growth around AI. And I think the reality is, beyond just some of the U.S. chip makers, if you look at Korea, okay, that is an index that has gone vertical this year, and yet their forward valuation is hovering around 6-7 times. And that's also mind-boggling, right, given what you've seen the performance. But I think the reality is, investor positioning, particularly globally, but even for some of these other parts of the supply chain, hasn't been as heavy as it's been on companies like the hyperscalers for the last few years. And that repositioning may have a lot more room to run if we're going to learn that some of the parts of this value chain that are most exposed to very attractive economics, because, look, we're going to be supply constrained around AI for the foreseeable future, for at least the next few years, those companies can come in and really participate more in this market.
Does the participation really broaden out? As you point out, the market for picks and shovels is just getting bigger and bigger. I mean, who would have thought Ford as an AI play? Yeah. And honestly, the stock rallied 13% yesterday on the idea that its batteries could be used in data centers. And it's not a laughable idea, right? I mean, it makes a lot of sense. So does that success broaden out? Do we see second and third derivative effects?
I think, broadly speaking, in different sectors like industrials, materials, we see a lot more runway. But I think at the end of the day, this is like a stock-by-stock kind of decision. What are the moats that they have? What is their capacity to ramp up supply in the face of demand? And, what is their competitive, moat in delivering that? If you think about something like advanced chip fabrication, like what, Taiwan has been doing for so long, that requires expertise that has taken decades to develop. And so I think there's a real question of, like, some of the competitors that are entering the scene here is, what are their core operations and how profitable can they be in this new AI business venture? Because, yeah, there's a lot of demand to go around, but what really matters is, how you can, produce that supply, your sensitivities to supply chain risks, input costs, and so forth. So all of that still matters.
Is there anything you want to steer clear of? I mean, this year, we've learned a lesson about software, for example, as it relates to the private credit, maybe overinvestment, because the concern is that AI eats their lunch. Now, that hasn't been decided one way or the other, right? But is there anything that you want to just be careful about right now?
Look, I think we're still quite bullish around AI over the medium to long term, but we do think investors should be buckled up. And when it comes to disruption, or what I like to say, AI is going to create this environment of heightened creative destruction. Creative destruction is nothing new, but it is something that's going to be happening a lot faster this time around. Some companies, some industries are more exposed to that. Now, in its wake, we're going to be left with more productive, profitable, AI-ready firms, but that process can be difficult, and investors today may not have all that visibility. today to estimate who those winners are going to be. So when it comes to an industry like software, a lot of the legacy business models, they need to be rewritten and redone. Where I have some caution, though, is just saying that it's going to be the demise to the whole sector, because we simply don't know yet.
Right.
And I think, you know, some of the recent positioning changes that these companies have made and reinventing the SaaS business model, like if you're catering towards agents, that could be a much wider demand pool than humans who are limited in nature, only have so many hours in the day, and are only going to use your tool tens of times a day at best. You have an agent that could be hitting your Salesforce systems or whatever it is, like thousands of times a day. You know, that is that's a significant shift, but can you monetize that? And I think that's going to be a big question. So I will say, when it comes to the software woes, like, some of that is definitely justified. Investors don't like uncertainty. We have a lot more uncertainty. But I think medium to long term, you know, there could actually be a lot of good news from this.
It's not boring, is it?
Yeah, no.
Stephanie, great having you on the program today. Thanks so much for joining us. Stephanie Aliaga there of JPMorgan Asset Management. Let's get a check on what's going on in the markets. About 7 minutes into the session here, we see the S&P 500 up 25 points. That's good for about 1/3 of 1%. This is the move screen. I think it's the most dynamic way to look at any index on the Bloomberg terminal. We have good breadth today. More than 310 stocks are gaining for 186 that are losing. You can see Nvidia adding the most points. Obviously, a $5.5 trillion company. When it moves, it tends to bring markets with it. It's adding 15 points on a 2.5% move. Broadcom is up. Cisco is up. Applied Materials is a gainer. Lam Research is up. So you see these big tech movers here. Among them, JPMorgan, Caterpillar, I guess, could be now an AI company, and ExxonMobil. The gas price, the oil price, and also the power story is one that we've been following closely this year. On the downside, Apple and Microsoft, as well as Intel and Google, are losers. Not big losers. You do see Intel shares down 3%, but they've had a monster run of late. You also see Eli Lilly and AMD and Qualcomm down today. So that's interesting to see a couple of those chip makers, and Micron a loser, only 0.7%. Obviously, Micron has been ripping face year to date. When we come, well, let's take a look at the industry groups here, I should say. IT, obviously the biggest gainer, financials and energy on the upside, healthcare, communication services, and materials on the downside. When we come back, I'm so excited to get to this story because Ford, obviously, an iconic car maker, right? A big industrial, maybe an AI play as well. After Morgan Stanley says it's possible they could do a deal with a hyperscaler for their batteries. That's next with Keith Naughton. This is Bloomberg Open Interest. Quick check on what's going on in the markets. We just showed you the S&P with the gain now almost 0.5%. It's 74.77 after another high yesterday, another high for the NASDAQ as well, and it is also up 0.5%, 29,510. Brent crude coming down a little bit, and it's at $105, while NYMEX is at 100. So that's bullish for markets. Time now for your top calls. Some of the analysts' action and focus this morning. First up, TD Cowen is upgrading Starbucks to a buy, saying its North America comeback is starting to work and should drive higher sales and earnings. The firm points to strong coffee demand, multiple sales drivers, and improving margins. Starbucks shares up 2%. Yeti's stronger profit outlook is drawing upbeat reactions from Wall Street. William Blair says investors have little to complain about as sales growth looks strong. Citi points to better than expected sales, but flags tariff pressure and weaker U.S. consumer as a risk. But the consumer doesn't seem that weak, and investors like the stock. It's up 9% in this morning is early trading. And finally, Morgan Stanley says Ford will likely land a big deal soon to supply battery storage systems to hyperscalers. The firm sees this new energy business as a major growth driver that could be worth $10 billion as Ford builds more capacity and wins customers, supporting its shift into a higher profit business. Let's talk about that right now with Bloomberg Autos reporter Keith Naughton. He joins us out of the Motor City. And Keith, what an incredible story, right? Ford fights currents for years to build this battery factory with a Chinese supplier, and now they could be selling container-sized battery storage solutions to hyperscalers for billions of dollars. Tell us about it.
Yeah, as my colleague Lee Denning wrote this morning, Ford now appears to be an AI stock. This potential for doing deals with hyperscalers has given the market a completely different view of this sort of old economy, 100-year-old warhorse. They now see it as being part of the AI boom. And why not? They're going to build these very large, batteries for data centers and for utilities and for hyperscalers that they'll put on sale next year. And demand for that is off the charts, right? It's expected to double by the end of the decade.
Yeah, one of these, I was reading about one of these DC blocks that provide like 5.5 megawatt hours of energy. If that were cars, it would be like 50 or 60 car batteries, right? And if you do a deal with one big hyperscaler, like a gigawatt campus, that would be like selling 200,000 or 300,000 EV car batteries in one fell swoop. So that just shows you how big this market could be.
Exactly. So that would be a full factory production worth of cars, right, Matt? So that's why people are so excited. Also, it's a very high margin business, over 20%. The car industry is a single-digit margin business. So Ford is still plugging away at electric vehicles. They have plans to launch an affordable one next year. But this really shows how they can pivot away from the weak demand EV market to the very, very high demand energy storage market.
It's interesting because I don't know if Ford was planning this or it just lucked into it because of a shift away from the full BEV market.
Yeah, luck has a lot to do with it, Matt. The plant where they're going to build these big batteries originally was planned as an electric vehicle battery plant. And of course, electric vehicle demand went south. So they are converting it to an energy storage plant. They also are fortunate that they already had the licensing agreement with CATL, the Chinese battery giant, and they'll be making their LFP batteries. So they've just shifted that licensing agreement to the Kentucky plant where these big batteries will be built. They're also going to build smaller energy storage batteries for consumers at a plant in Michigan that will open this year that will also make EV batteries. So the CATL deal really gives Ford a leg up among all automakers who are trying to make this pivot to energy storage.
Yeah, in fact, I always pull up the comp function on the Bloomberg to look at shares of one car maker versus another or a company versus an index. It defaults to 5 years. Over the past 5 years, total return on Ford stock, 60%. It has now outpaced General Motors to be the biggest winner in a 5-year period, beating Stellantis, beating out BMW, Volkswagen, Mercedes. It's the strongest stock in 5 years of all the car makers that I looked at, not including Tesla, of course. Do you think we're going to see others follow suit here, Keith?
Yeah, I mean, General Motors, Stellantis have both said they are going to get into the energy storage business. They have to do something with this battery infrastructure that they devoted billions of dollars to. So they're trying to make this change over to energy storage because it's such a great growth business. You can get into it more quickly. The overhead is lower. Ford will have this up and running by next year. They're investing $2 billion to get it going, and the returns could be very high. The analysts are saying it's a $600 million a year EBIT business.
All right. Fascinating stuff, Keith, and really appreciate your reporting. Bloomberg Autos reporter. He covers Ford for us. Keith Naughton out in Detroit. Definitely check out his work on the terminal. There's a great story that Keith and Colin Murphy wrote about the deal that Ford did with Cattle as well, or CATL, in Marshall, Michigan. Also, check out my podcast with Hannah Elliott. It's called Hot Pursuit. You can search Bloomberg Hot Pursuit on any of the platforms where you find podcasts, and just relax and enjoy an hour of car talk. Coming up next, AI chipmaker Cerebras gears up for the biggest IPO of the year so far. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing just about 21 minutes into the session. We're at all new record highs. It doesn't matter what happens with oil. It doesn't matter what happens with rates. It doesn't matter what happens with the Fed. All that matters is AI CapEx driving us to 74.75 on the S&P, driving us to 29,500 on the NASDAQ. Check out, okay, we do have oil down a little bit. Brent crude off about 0.5%, and it's only $105 a barrel now. NYMEX is only 100. But you have huge gains on, it's really earnings driven by tech, right? Klarna up 10%, Viking up 10%, Nvidia gaining 2.5% on hopes that some Chinese companies will order some of its lower-level chips. Alibaba doing poorly. By the way, if you look at the summit and try and determine winners versus losers, U.S. companies, U.S. tech companies are really soaring today, and some of these Chinese companies are doing poorly. So maybe the U.S. is getting the upper hand in those trade discussions. Ford up 5%. Now the maker of my beloved Raptor and the Mustang GTD is a tech company making batteries, hopefully for hyperscalers. Morgan Stanley says they could get a big deal soon. And Cisco knocking the cover off the ball with its revenue outlook up 15% in the early trade. So these markets continue to soar as we get a new entrant, AI chipmaker Cerebras, raising $5.5 billion. It's the biggest IPO of the year so far. Let's bring in our IPO, meme stock, and SPAC reporter, Bailey Lipschultz. So it's, on the one hand, it's an amazing story of oversubscription, right? I mean, so many, everybody wanted to get their hands on these shares. They were going to sell them for $150 or $160, and they finally got out of the gate for $185. What do we know about Cerebras?
Yeah, big rally, big expectations. As you mentioned, $150 to $160 was actually well above what they initially were targeting when they launched. Some of our colleagues broke news that ARM and SoftBank were actually trying to acquire the company just in the weeks leading up to the IPO. But there are lofty expectations, as you can see. Market value about $40 billion. We have had subscription levels north of 20 times. Talking to buy-siders, there was more than $10 billion of demand for this IPO before it even launched. We haven't seen that in quite some time. And I want to call out the obvious and say semiconductors are absolutely in fuego. So if the SOX is up 50% in 2 months, it makes the bankers' jobs quite a bit easier.
Of course. Now, on the other hand, we say biggest IPO of the year, right? But they raised $5 billion, and SpaceX is going to raise like 75, right?
It's still big. So this would
I know, but it's a $50 billion market cap. Nvidia is still worth $5.5 trillion, right? I mean, their sales are less than 0.25% of what Nvidia does in sales.
It's crazy, though, that in 2026, we're calling a $5.5 billion IPO small because SpaceX wants to raise $75 billion at a potential $2 trillion valuation. That is not normal. That's not normal. But this is.
We're getting older, Bailey. We're getting older.
As we mature, our relationships mature. But yeah, no, I mean, this is right in kind of in vogue with everything that's been working. We've been seeing alternative energy rallying, anything around AI. If you're a chip maker, with the kind of thought that you could compete with Nvidia. To your point, if we're talking about a $5 trillion company, $50 billion, $100 billion is a small fraction of that.
I mean, the fact is we've already seen companies like Nvidia and the other hyperscalers. We've already seen valuations on non-public companies like like OpenAI and Anthropic soar. Yeah. And investors are just looking for anything else, right? So even if it's a company that only makes 0.25% of the revenue in Nvidia, they're all in.
Well, and this is a company that tried to go public a few years ago at a small fraction of this. They raised money privately not too long ago at a fraction of the 40 billion, potentially much larger than that, depending on how it trades. So we've just been seeing quantums of capital being plowed into anything around this. And again, it's one of those conversations that, are we going to look back 5 or 10 years from now and say that was kind of interesting back in May of 2026? Or is it the start of a seminal event? And that's kind of the beauty of markets, as the bankers tell me.
All right, Bailey Lipschultz, great to have you on the program. Are you hosting Bloomberg this weekend?
No, not yet. That's August.
Oh. Okay, I heard
so far
Christina Ruffini said, Bailey's going to be on with me, and I was like, I'm going to tune in for that. By the way, you can also tune in for the CEO of Cerebras, Andrew Feldman. He's going to join Ed Ludlow on Bloomberg Tech at 11:30 a.m. Man of the hour. In the next hour, the man of the next hour, Invesco CEO Andrew Schlossberg joins us on this program on what comes next for the asset manager. He's going to be interviewed by our own Katie Greifeld, and Rezilient CEO Dr. Danish Nagda on cloud clinics and affordable healthcare, making deals with maybe your employer or your insurer. Plus, Dani Burger moderates a panel on the AI-powered workforce with the CEO of Bridgewater, Nir Bardea, and others. This is Bloomberg. We are 30 minutes into this trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Burger is on assignment. She's moderating a panel with the CEO of Bridgewater. We're going to bring that to you shortly. Coming up, President Xi presses President Trump on Taiwan, warning of potential clashes if that issue is mismanaged. Also, the tech rally continues with strength as Cisco soars on a raised forecast and an AI-focused restructuring plan, plus an exclusive interview with Invesco CEO Andrew Schlossberg. He discusses the firm's strategy as competition intensifies from BlackRock and State Street, and we've got an expert interviewing him in our own Katie Greifeld. But we begin with the summit in China. Presidents Trump and Xi wrapping up their first day in Beijing with trade, Iran, and Taiwan all in focus. Xi said the talks laid out a vision for constructive, strategic, and stable ties with the U.S.
The relationship between China and the USA is going to be better than ever before. Tonight, it is my honor to extend an invitation to you and Madam Peng to visit us at the White House this September 24th.
China and the United States both stand to gain from cooperation and lose from confrontation. We should be partners, not rivals. We should help each other succeed and prosper together.
Xi also warned Trump the Taiwan issue must be handled with extreme caution and could lead to conflict if mishandled, stating, I believe, the obvious in that. Joining us now from Beijing is Bloomberg Washington correspondent Tyler Kendall. And Tyler, speaking of stating the obvious, we're getting headlines from Marco Rubio saying China trying to take Taiwan would be a mistake. I mean, the obvious from our perspective, of course. But he did say also that it's hard to ignore the pace of Chinese military growth. And Bloomberg pointed out yesterday in our big take that they've likely doubled the size of their missile arsenal or missile production. What's it like on the ground there in Beijing?
Well, at this point, Matt, you're right. We have seen this massive buildup when it comes to the military equipment and weaponry in China, as the U.S. has tried to bolster its own defense industrial base to compete and raise stockpiles abroad. And I have to say that it's clear that the efforts here in Beijing are more geared toward trying to stabilize relationships than it is overhauling them between the U.S. and China. But really, this point of contention raised directly by Chinese President Xi Jinping does threaten and risk dampening what has so far, I think it's fair to say, been a rather cordial mood. Now, his comments do fall in line with what has been long-standing Chinese policy, though they do mark his bluntest remarks so far and come after days of U.S. officials signaling that the U.S. would not have a change in policy regarding Taiwan. In fact, the U.S. public readout of the private meeting today didn't even mention Taiwan. Instead, it was really focused on the economic relationship between the two countries, including previewing potential purchase commitments when it comes to U.S. agricultural products and energy goods. We heard from the U.S. Treasury Secretary Scott Bessent, for example, in an interview trying to highlight that we could even see a reduction in tariff on nearly $30 billion worth of goods. I will also point out another area where it seemed to be a perhaps mismatch in the public readouts, not just on Taiwan, but also on Iran. The U.S. side saying that China agreed that the Strait of Hormuz, for example, needs to be an open and free waterway. Yet the Chinese statement at this point instead referenced that there was a conversation about the Middle East and the situation happening there, not explicitly mentioning Iran by name. At this point, Matt, we haven't gotten indications that China is going to push Iran to reopen the Strait of Hormuz, do more to get Iran to the negotiating table in a more meaningful way after the U.S. just recently rejected that latest latest counter-proposal, though I will say that the dialogue continues tomorrow. The pair of leaders have a set of bilateral meetings. And then I'm sure, as you saw, President Trump formally inviting Chinese President Xi Jinping to come to the U.S. on September 24th for a state visit at the White House.
All right, Tyler, thanks very much. Tyler Kendall there on the ground with our team in Beijing. Also in Beijing is Anne-Marie Horton, and I will point out on trade, she's going to talk to our own U.S. trade rep, Jamieson Greer, later on tonight. So tune in to Bloomberg or set your DVR. Do they still have DVR? Set your DVR for 8 or 8:30 p.m. Let's get now to the Global Citizen Now event, where Danny Berger is moderating a panel on the AI-powered workforce. She's got Bridgewater's CEO Nir Bardea there, as well as the Chief People Officer at Cisco, whom you're looking at right there, and Authentic Brand CEO Jamie Salter. Let's listen in.
Young to old, and I'm one of the older guys, that learn how to use it, and then there's people that are really scared to learn how to use it. And I think that people, why workforce is changing. It's not necessarily that you're going to reduce your workforce by 25%. You may change your workforce by 20%. And the reason you may change your workforce by 20% is because 20% of the existing workforce does not want to learn and how to use AI. So, I mean, it's no different than, Excel. When I was, much younger, if you didn't learn how to use Excel, it used to say on your resume, okay, do you know how to use Excel? And if you said no, you never got that job. So I think it's just really important that the younger generation learns how to use AI, but the older generation also has to learn how to use AI in order to change their skill sets. And I think that what we've seen is, a really good change in our organization. We have almost, I would say about 80% of the people are now using AI. And we have reduced, I'll give you an example. In finance, it would take us 700 hours to do all the reporting that we have to do on a regular basis per week. 700 man hours or women hours per week. Today, it's 100 hours. So think about that reduction is 90% almost in man hours. So that gives you an enormous amount of time to actually do other things and spend more time with, the different, VPs and EVPs to actually, read those reports and do something about it.
Right. I mean, Nir, the conversations around AI and hedge funds and asset management, I mean, Bridgewater has been doing some form of machine learning really since its inception. But now you have a new, more powerful tool. And there is this narrative, Ken Griffin, for example, has said that AI doesn't produce alpha. I know you have a lot of machine learning powered, AI powered hedge funds, strategies rather. Would you agree with that? That there still needs to be a human element to create alpha, that AI itself cannot create alpha in your business?
First of all, it's so great to be here. It's never been more important to gather and talk about these topics. And even if there's like a become vibe to what's been said, I think what's coming both in AI, energy, geopolitics is going to disrupt the world completely. It will be unrecognizable, which is why this is so important. Just want to start there. Now let's go to hedge funds.
Let's start with the existential point. Yeah. I like it.
Let's go to hedge funds. Look, I think both things are true at the same time. Yes, we have a fund that we've rolled out 3 years ago that is completely focused on an artificial investor. That means AI generates the insight, trades billions of dollars, and competes with our expert system, which is the previous version of AI. And it's a close call on who's winning, and it's the worst that it's ever going to be. So on one hand, this is going to change everything. But the thing that it's going to change is the combinations between humans and technology, which is not to say humans will not be necessary. Even in that fund, that fund, for example, to your question, created an upward pressure on our headcount because we needed to build a team that is large to do that. So you'd have a different combination of human and technology. The thing that I would really focus on when thinking about this is the difference between a productivity increase, meaning we're doing something like humans would do it, but trying to do it more productively. I think that is an evolutionary change. versus I would think about AI like an alien technology. You know, AI looks at humans fold clothes, and that's mind-blowing to AI. They're like, show me yourself folding clothes, and maybe I'll be able to learn it one day. We look at how AI does certain things and we can't figure it out. How did you get there? Yep. And if we keep just focusing on using AI through human-led processes, we're only going to get the productivity increases. Once things start to get rebuilt, the factory get rebuilt around AI intelligence, you will find capabilities changes. I'll give one example of that just to make it visceral, because I think we're in that moment right now. We've been looking at Bridgewater for what we call kind of the Barnes & Noble's moment, right? Remember when a technology came and disrupted an industry so deeply that it led to almost extinct. That happened when Amazon came and caught Barnes & Noble's off guard. It's happening right now. If you look at application software stocks, and Cisco is having a great day, but as an index, they're down 40% because they're going through a holy crap moment. How different are things going to be when the whole factory is wired in a different way?
By the way, are you a believer that what we are heading towards is this future of AGI that like completely reshapes humanity? Is that what you're talking about? That some of the freak out in markets, it's calmed down now, but is warranted because things are going to fundamentally change?
The thing I will bet completely on is that things are going to fundamentally change, yes. What that's going to look like, I think, is a very hard question. Let me just expand on that for a second and why I think it's obvious that things are going to change, why they're already so different right now. Think about three reinforcing dynamics that are happening. For years now, we've been in the biggest investment cycle because people are banking on exactly what you're saying. They're like, the prize is so big that I'm going to spend everything I've got. All the tech companies that had tremendous amounts of cash spend their balance sheets down. Governments are spending their balance sheets down with that promise. That is already, forget about what you think is going to happen, changing everything. That followed with capability changes. Coding, 3 years ago or 2 years ago, AI could do 5 minutes of coding. Today, it's 12 hours of coding, and scaling keeps going on, so that's going to keep expanding. If you look at Anthropic's earnings a year ago was $1 billion. It's now $30 billion as of this month. These are wild changes, and couple that with what's happening in the world, which is we've left one paradigm in the world of globalization that we've been in for decades and moved to a much more adversarial world, which feeds AI also. Because nations, China and the US are saying, well, it's a winner-take-all world. I got to invest in capabilities that are going to make me win the geopolitical race. No matter how you cut it, the world is going to be a radically different place.
It feels like there's no break in that. But, Fran, I mean, you live the here and now and see daily how people are using this. And I wonder, one, if you agree with Nir that we are going to a fundamental change, and two, how quickly that will happen. I think about there's this great FT report basically saying that there are a lot of employees at Amazon, and Amazon had been pressuring their employees saying, you need to show us that you're using AI. And basically all the workers just started using random tasks for AI to prove that they were using tokens and to make themselves look good in front of their bosses. So is that change actually happening now? And do we get, again, to that place, to Nir's point, that is a fundamental change?
I do think that things are going to change fundamentally. I do. I don't think we know the timing. But we can't forget the role of the individual. And so I think a stat that's really compelling at Cisco is that for those people that are active AI users, they feel more proud of the Cisco brand, and their retention is a lot stronger. And what that means is I think that employees want to feel like they're working on the most important parts of the company and the broader mission. And so we can't forget just that connection to work, to progress, to impact. I think that makes our people really proud. The other thing that I would say is the two groups right now at Cisco that are using AI most actively, the first is employees that are with us for less than a year. I don't think that'll surprise you. The second group is employees that have been with us for more than 20 years. And so what that tells me is that it's an opportunity for everyone, and we have to look at it that way.
Right. Jamie, I would also love a very specific look at how AI is impacting your industry. I was speaking with a Citi M&A banker legend, Christina Moore, yesterday, who said IP is more important than it's ever been because of AI. Are you seeing the same thing? Just because of the sheer volume of content out there, that valuable IP is just that, even more valuable now?
I mean, look, there's so much muck on the internet now. Is it real? Is it not real? Is it AI? Is it the real person? And you're seeing a lot of that. So I think what's going to happen is there's going to be a lot of new laws that are going to be put in place, you know, where you have to say whether it's an AI ad or whether it's sort of a real person's ad. But I'll give you a real example. Marilyn Monroe. So we own the estate of Marilyn Monroe, 100% of the estate. And Marilyn Monroe, you know, sure, we can put her to work, but now we can really put her to work. And the truth of the matter is, you know, if you don't own Marilyn Monroe's IP, then
all right, that is Danny Berger speaking with, among others, the CEO of Authentic Brands, Jamie Salter, the CEO of Bridgewater, Nir Bardia, and Cisco's Chief People Officer. You can continue to listen to this conversation on your Bloomberg terminal. If you want, just type live go and choose that. Let's get now downtown, where Bloomberg Close co-host Katie Greifeld is sitting down with the CEO of Invesco, Andrew Schlossberg, for an exclusive interview. Katie?
Thank you, Matt, and thank you, Andrew Schlossberg, for having us here at your offices. I want to start broad here. I have a ton of ETF questions, but I'm going to try to restrain myself a little bit. Let's talk about what we've seen unfold over the past couple of months, because as you well know, there has been a ton of volatility in markets. And I wonder, you know, how that is affecting what you're seeing when it comes to the product lineup, how clients are thinking about allocating, and how their risk appetite has been shifting.
Yeah, well, first, thank you for the invitation. Thanks for joining us here in our offices. You know, I think clients are, frankly, leaning into the volatility that's been in the market. I think they're starting to get a little more comfortable with volatility being a norm. And we're really seeing every client around the world, whether it's an institution or an individual, want to get more personalized about their portfolio and customize. So, you know, things like taxes in the U.S. and how people are trying to manage them is really important, or inflation hedging. And that's why we're really focused on making sure we have a diverse range of products that can meet all those needs. And frankly, we just reported our AUM for the month of April, and we had about $20 billion of net new flows. So clients are active, but they still have some cash on the sidelines.
Absolutely. And getting clients out of cash, I know that has to be one of the conversations that you're having. I do want to talk a little bit about what's going on in private markets, because, you know, you think about even before the outbreak of the war in Iran, that's what we were talking about, the SaaSpocalypse, if you want to call it that. I know that Invesco has been pushing deeper into private markets. You have several partnerships. Chief among them are your partnership with Barings. You do have one product in the marketplace that's live, but you think about what's going on with the retail investor landscape, you know, some of the turmoil that we've seen there. Has that sort of thought prompted you to think about redesigning any of the planned products that you have, or the planned timing of those rollouts?
Yeah, so Invesco, we've been in private markets for about 40 years. We have about $135 billion in assets across private real estate and alternative credit. So we've been serving institutions for a very long time. What's happened in the last few years, as you know, is the interest of wealth managed clients, high net worth wealth managed clients, and now more retirement clients in their 401ks or other such plans around the world. And we've seen that uptake happen. And so what we've been focusing on is how can we create the right kinds of product strategies and the right kind of delivery, lots of education, lots of operational ease. And I'll use the 401k as an example. We just did a survey. 85% of plan sponsors and participants want to see privates in their 401k plan. And it really makes sense. I mean, target date funds are professionally managed. Assets are long dated. And if we can create structures that make sense for a 10 or 20% allocation, we just think that's good as assets shift from defined benefit to defined contribution plans. So I think we're at very early stages in the industry of this.
Interesting. So again, what we've seen over the past couple of months, not necessarily causing any sort of rethink or redirection.
No, not at all. I mean, look, investment quality and delivering in packages that make sense for clients has got to be the priority. I think what we're learning through this is a lot of education is needed as well. And that's a big focus for the firm. Whether it's individuals or retirement plans, education is going to be key.
All right, so let's get a little bit into ETFs. Because,
Sure.
I've been dying to talk to you about the QQQs. Of course, that is the Invesco NASDAQ 100 ETF. It's one of the biggest, oldest ETFs out there, and it finally actually is an ETF.
That's right.
A lot of people didn't know this, but it was a unit investment trust, and you finally, got the proxy votes to convert it into an open-ended ETF, which basically frees up a lot of money for you because you don't have to spend so much on marketing as was written into the prospectus. Talk to me about that process, because you think about the Qs, the number of shareholders you have in that fund. Right. I mean, it amounts to a small country at this point, I think. And, you had to cross the threshold of 51% approval from your shareholders, the ultimate exercise in herding cats. What was that process like? I mean, how much money, how many resources did you aim at just trying to corral all these votes?
Yeah, I mean, the Qs, as you said, is really an amazing flagship fund, not just for Invesco and our ETF franchise, but really widely held around the world. And it keeps growing. I mean, the assets in it today are around $450 billion. And the wider innovation complex that we have at Invesco around it is about $600 billion. So your point is, it's large and it's very widely held. And we were really pleased to be able to make that conversion happen in December. And it was a lot of work, but the shareholders in that fund, the millions of shareholders, voted to make that conversion. Fees are going to be lower for them. Of course, there is revenue for Invesco, but it's going to really enable that fund to continue to modernize and be the bellwether that it is. And we're really proud of that, and we're really excited to continue to take it to even more individual investors and institutions around the world.
And so I'm paraphrasing here because it is quite wonky, but the net effect of converting it into an open-ended ETF, again, you don't have to spend so much on marketing, and basically you're able to actually earn a revenue here because in its former format, you basically didn't see much revenue from that product at all. And it's interesting, since the proxy passed, since we saw the conversion, NASDAQ has come out and they're actually letting other firms license the NASDAQ 100. Invesco had the rare privilege of being the only firm in the U.S. to have a NASDAQ 100 linked product. And, I would just love to hear your reaction to that, because obviously that exclusivity has directed hundreds of billions of dollars into the Qs over the past several decades.
Yeah, I mean, given the Q's size and its holders and everything we just talked about and the 25 years we've been involved, I mean, we've built an amazing brand for that index and for the QQQ product, which is really one of a kind. And being able to continue to do that is really going to be our focus. The ETF trades with amazing liquidity, really tight spreads, not to get wonky back at you, but also it has $500 billion of notional options traded against it. So it has a lot there, but we continue to think it's going to be the bellwether. And as people continue to have interest in the U.S., large cap, largely growth markets, that's where they go. And they know QQQ, and that's where they're going to be focused, and that's where we're going to spend our time.
So not concerned?
We're focused on growing the Qs franchise. We compete with people in the ETF business all the time, and we've been able to grow that franchise to $1.2 trillion. And it's been growing its market share. So we compete on quality and differentiation and price and all those things. It's kind of par for the course.
Well, I do want to talk a little bit more specifically about your relationship with NASDAQ, because the theory is out there that because you aren't mandated to be marketing the Qs and by extension marketing the NASDAQ 100, that is one of the reasons why NASDAQ chose to sort of extend the licensability of the NASDAQ 100. And I wonder, what those conversations have sounded like with the firm.
The NASDAQ and us are great partners, and we have been for decades. I mean, we have dozens of funds, not just the Qs here in the U.S., but part of that $600 billion innovation complex. So we continue to look for ways to invest behind the Qs, both with the NASDAQ and on our own. We're going to continue to invest, and we said it in our proxy, upwards of $100 million against the QQQ, which is more than any ETF I think has ever had against the marketing of the index. So we're going to go from strength to strength. It's a great partnership.
Well, speaking of the NASDAQ 100, SpaceX is a company that could be coming public next month, and we know that NASDAQ is set to sort of fast track that company to be included in the NASDAQ 100. There's been a lot of consternation from that point, you know, a lot of worries about what this will mean for the index and the products that track it. And I wonder where you fall on that conversation.
Yeah, I mean, the index providers and teams, you know, they make the decisions about what's included in their index. You know, we create ETFs around that index. We want to make sure our ETFs have the diversity that they're expected to have, do what they say on the tin, of course. And, you know, the NASDAQ 100 is meant to include the biggest companies that are out there. So, you know, as new companies get listed, we're big advocates for people going to market and the capital markets continuing to hum here in America, which means more listings, more IPOs. So we're excited about continuing to have that fund represent the best and the biggest here in the United States.
And Andrew, I do want to talk a little bit about you because you have a really interesting resume. You're sort of a homegrown talent at Invesco. You've been here for over 20 years. You took over the CEO helm about 3 years ago. And in that time, I mean, Invesco shares have risen, I think, close to 120% on a total return basis. You're far outpacing your peer group. And I just wonder what, you know, the next 3 years, the next 5 years look like for you, what you will be prioritizing and what you want Invesco to look like going forward.
Yeah, well, thank you. I mean, we really have the benefits of an amazing foundation here at Invesco. Of course, we're a big global scaled asset manager. We're almost $2.5 trillion in assets under management. But way more important than that is how diverse the business is across active and passive, public, private, and now international is 40% of our client assets come from somewhere outside the United States, which is really important. And so myself and the team, we've been really focused and will continue to focus in 3 main areas. And it's really around innovation, around clarity, and around delivery. And what I mean by that is innovation for our clients. We've been doing a lot on the product line, like we talked about, partnerships, and this personalization theme. And then in terms of clarity for our business, it's been a major focus. Let's just pick 5 things and really focus on those and sort of declutter the rest of the company. We've been divesting some things, we've been de-emphasizing some things, and making sure we have a culture that's collaborative and decisive. And so we've done a lot to simplify the business. And then, as you mentioned on delivery, first and foremost, it's for our shareholders or for our clients, pardon me. And it's been about delivering investment quality. And they've rewarded us with $150 billion of net new flows in the last 18 months. And for our shareholders, you mentioned it, but earnings were up 25% in the last quarter we reported, delevering the balance sheet and continuing to reinvest in the business while returning capital to shareholders. We've increased buybacks, increased dividends. So those things are the things we're going to continue to focus on.
All right, Andrew, great to get some time with you. Really appreciate it.
Thank you very much.
All right, that is Andrew Schlossberg. Back to you, Matt Miller in New York.
All right, Katie, thanks very much. Katie Greifeld there with the CEO of Invesco. Let's get a check what's going on in the markets right now. Looking at all new record highs by the time Katie and Romaine come on. If this holds, we'll see another one, 74.79. Coming up, a new model for healthcare. Can AI make it work? We'll speak with Rezilient founder and CEO Danish Nagda next. Healthcare access remains a major challenge with patients in cities like right here in New York, often facing long wait times and a shortage of doctors. Companies like Rezilient are trying to change that by combining telehealth, in-person care, and AI assistance. And for more, we have the CEO and co-founder of Rezilient Health here, CEO Dr. Danish Nagda. This is a really exciting story, Danish, because it's so difficult to see a health care professional in person these days. A lot of times insurers really limit your access, and employers want to find a solution. They're making deals with companies like yours.
Exactly. I mean, at this point, it's gotten so bad that there's an entire movement around this called the direct care movement. You're seeing direct primary care, direct contracts. I mean, we just saw 32 BJ Union do a giant deal with Northwell directly because it's just getting untenable.
And, you know, just a couple weeks ago, my 2-year-old broke her arm. I had to make an appointment with the pediatrician, go to the pediatrician. She had to refer me to an x-ray, you know, and if I had been using telehealth, it could have been done that much faster.
Well, especially if that telehealth had the ability to examine the patient, right? So that's the thing that's different about our model is that we're not just limited to FaceTiming your doctor. You can go into one of our physical cloud clinics and the doctor's actually on the screen. There's an assistant that can help with that exam, maybe even do imaging and labs.
How do you set up those cloud clinics? I mean, that seems like a big real estate red tape problem. How many do you have around the country?
So at this point, we have 50 state coverage for our practice. We have 5 states where we actually have physical cloud clinics. These clinics actually, what we do is we go into an existing medical office unit like a doctor would. We put nice flooring, put nice paint, and put our technology in, and we go live. The average cloud clinic costs us less than $150,000 to go from idea to start.
And actually, the pediatrician I visited was not even a doctor; it was a nurse practitioner. So
Exactly.
I guess it's the same kind of idea, but just not as well executed.
But the challenge is when you have the doctor on the screen, that doctor is now available to you at all of our clinics. So you never have to change doctors again.
So, are you making deals then with companies, with employers
Yes.
that can obviously do a favor to their employees, their workforce, but also cut costs this way?
Yeah, I mean, what we've shown is that, and it should not surprise anybody, that if you don't end up going to the emergency room, to urgent cares, to downstream to the hospital because you couldn't get access, it actually saves you money. So by providing concierge care for your employees, you actually end up saving money not only in year 1, but much, much more in year 2, 3, and 4. And so, yeah, we're cutting deals. We have over 300 employers that offer Rezilient as a benefit for their employees, and they make it zero cost to access concierge care.
How fast? I mean, 300 employers. I know you're on the road all the time,
Yes.
probably talking to partner or potential partners. How quick has the growth been, and what do you expect?
Yeah, this year we grew 400%. The year before we grew 300%. So we've been growing at a very rapid rate. And partially it's because we have an incredible team and we provide primary and specialty care at the same place. But it's also because I think we're at a real tipping moment, a tipping point here in healthcare.
I know my buddy Joe Kaiser, who's like a genius early AI investor, is interested in getting a piece of your company. What's the funding look like right now?
Yeah, so we've raised about $30 million to date. Joe is one of our investors. Incredibly excited because what the core premise is, once you put the doctor on the screen and all the tools and the sensors on the physical infrastructure, you can actually lead to a world where we do autonomous care delivery, which is what I know Joe and others are excited about. We are obviously growing very quickly, and we will need to continue to raise to meet those needs.
So I'm so fascinated in the business itself because as a consumer or as an employer, I think it makes a lot of sense. But in terms of the financing side of it, how does the run rate look to you? I mean, you're going to raise funds again, then eventually, I guess, you IPO, or is that even a necessary step these days?
I mean, we are always focused on how do we get a cloud clinic in every city in America. When we do that, you will never have to change doctors again. The whole healthcare system will be different. You will go to one clinic and you'll have the opportunity to choose from thousands of doctors that you actually love. And you'll never have to worry about that in the long run. And so that's what we're focused on right now. We expect to continue financing our growth, but we will only do it in a responsible way so that way we can continue to grow at the rate that we're growing.
Never having to change doctors again sounds promising. I just went through an unfortunate situation where my insurer broke up with my healthcare provider, right? And they fought for a few months before they got back together. I had to look for a new GP. How do you deal with insurers?
I mean, to be completely direct, we cut them out of the middle. So we actually partner directly with the employer because it's also difficult for the employer if suddenly the health system is taking out a network and that primary care doctor is not there. That change in continuity affects costs significantly for the employer. And so by having a partner direct where I don't care what insurance you have, right? Most people are getting health insurance through their employer. And this is the part that most people don't know. The employer is actually the risk bearer. So Bloomberg is self-funded, for example. You're actually taking on the risk of your own employees. Why should you be limited to one payer's network?
So what kind of competition do you have? When you're on the road, knocking on the door, talking to all these Fortune 500 companies, signing contracts, who else is looking to get a piece of that business?
I mean, obviously, they're the big Amazon with One Medical is a big competitor in the space. We have companies like Marathon and Premise. But what is incredibly different about us is because we're built on a digital backbone, we're actually able to bring AI agents into the physical experience and at home. And to have a fully integrated AI native experience is something that nobody else can provide right now.
All right, well, it's a fascinating story. I hope you come back and tell us more about it. 400% growth, nothing to sneeze at, and we'll look forward to seeing how you're doing in a couple months or years. Rezilient Health co-founder and CEO Dr. Danish Nagda. Let's talk about another company that's gone through growth like that and now is public, Cerebras. Those shares that they had marketed at 150 to 160, eventually sold at 185 because there was 20 times demand, are now looking to open at $380 a piece. A massive jump, more than doubling the initial offering price. It is the biggest IPO of the year so far, raising more than $5.5 billion. And you can catch the Cerebras CEO, Andrew Feldman, today on Bloomberg Tech. He joins our own Ed Ludlow at 11:30 a.m. New York time. That's an interview you don't want to miss. In terms of the markets right now, we're looking at new all-time highs on the drive from companies like Cerebras, from Cisco, from Ford. The AI story continues to inflate these markets right now. The S&P 500 at 74.84, the Nasdaq at 29,552. Let's get a look at some of the single stock stories at this hour. Cisco, as I mentioned, boosting its full year forecast, announcing job cuts. Investors like that and bid the stock up 15% in the cash trade. Reuters is reporting that the U.S. has cleared around 10 Chinese companies to buy Nvidia's H200 AI chips. Now, they've had clearance to sell to Chinese companies for some time now, but we haven't seen the demand. Nonetheless, investors happy about that, bidding the shares up 4%. And Morgan Stanley issuing a bullish call on the Ford Motor Company, saying the Blue Oval's energy storage business could make a deal soon with hyperscalers. The CEO, Jim Farley, says Ford is already seeing strong demand for its energy storage batteries. They're the size of a shipping container and are 5.5 megawatt hours strong. He says they're going to go into production late next year. Coming up, private markets could unlock stronger returns. Franklin Templeton CEO says your retirement account could be the perfect place. Highlights from our interview with Jenny Johnson next. This is Bloomberg Open Interest. Franklin Templeton CEO Jenny Johnson says retirement accounts are the best fit for private credit and private equity because investors can better withstand years of illiquidity. She spoke exclusively with Bloomberg's Francine Lacroix on The Pulse.
I think the fundamental change is around bringing private markets so you have true democratization to the average investor, right? Now, here's why it matters. Just take investment grade fixed income. So if you invest in investment grade fixed income in the private markets, you're getting a 1 to 1.5% excess return on that. Problem is, you can't get your money for 10 years, so you really need to be able to withstand that illiquidity. On the other hand, a 1% additional return can mean 20% more just over a 20-year period in your retirement. Like, that can make the difference between whether you have enough money or not. So to me, it's all about matching the right vehicles with the needs, because these are illiquid. It drives me nuts when I hear people acting like, oh, no, private credit's more liquid than you think. It's not. But it can be put in vehicles as a percentage of a vehicle that keeps the vehicle very liquid. And so I think that that's very important. And honestly, I think the best place for this is in retirement accounts, like in the U.S., but in the challenge because people, put money in their retirement thinking that they're not going to get it until they don't need the liquidity.
And it's opening up a bit.
It is, but the reality is it's probably the highest, most litigious space in investments. And so, it's all focused on fees, and these aren't cheap products.
And that was Franklin Templeton CEO Jenny Johnson speaking with Bloomberg's Francine Lacroix. Let's get some more insight into private credit's push into your 401k. We're joined by Silas Brown, Bloomberg senior private credit reporter. And Silas, it makes sense, right? I mean, if you're putting something in your retirement account, you're not likely to try and access that cash. So to the extent that you don't need the liquidity, it fits.
Yeah, and it's back to the old, one of the first selling points of private markets, the illiquidity premium. And I think Jenny Johnson's point, is well stated, which is that over periods of time, that illiquidity premium can stack up and make quite a compelling kind of profit, essentially, for clients versus, the classic public fixed income products that they may be able to access already.
Well, and for years, teachers and police officers, firefighters, through vehicles like TIAA, CREF, or CalPERS have had, of course, these investments in their portfolios, whereas individuals who are running 401ks or even having them directed by RIAs aren't able to access them. How soon will they be able to? What vehicles are allowing that kind of access?
Yeah, so I think look, this is the point for democratization. I think the proponents of it, such as Jenny Johnson, will say, well, look, people have access to the stock markets. They have access to a variety of publicly traded financial instruments. But a lot of the activity now is happening in private markets. So why can't they have access to them as well? I think I would say that it's a trickier time to be making that case. What with the volatility at the moment going on in private markets, the looming spectre of AI and its impact on software, not to mention the inflationary pressures that have been brought about by the geopolitical crisis in the Middle East. So it's a sort of trickier time to be making the case. But I think in a sort of like the broad sweep of the argument, I think is kind of well stated.
Well, and I mean, as far as I understand it, Silas, and I'm not as deep in it as you or Dani. It's a trickier time to have been invested in these kind of assets, right? Because the vintages 2021, 2022 are those that are having issues. And from what I understand, everybody's after this year, right? In terms of institutions, as retail gets spooked, institutions are there ready to buy it up.
Yeah, it sounds like you have better knowledge than me. But yeah, I totally agree with you. I think that's right. Like, I think, the 2020, 2021, the kind of years of the froth, definitely the ones that people are most concerned by. And now I think you see the kind of bigger, like, sort of luminaries in private credit and also private equity clamoring for cash to invest in a kind of sort of like headier, more opportunistic environment. And so yeah, I think that's true.
All right, Silas, great having you on the program. I'm so bummed out that I missed you when you were in New York, by the way, last week. But next time, we got to get together.
Time.
Bloomberg Silas Brown covers private assets for us. Coming up, the U.S. and China look to ease economic relations with a, quote, board of investment. We'll explain to you what that is next and how it could work. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Wes Streeting has resigned as Keir Starmer's health secretary. The move paves the way for him to challenge the UK Prime Minister for his job. Starmer is fighting to stay in power after nearly a quarter of his Labour Party publicly called for him to resign in the wake of disastrous local election results. Streeting is only one of the party figures likely to throw their hats into the ring in case a formal leadership contest begins. Retail sales advanced for the third time last month, pointing to some signs of consumer resilience even as gas prices rise. The report suggests higher than usual tax refunds help provide a financial cushion against mounting inflationary pressures. Meanwhile, a recent data from the Bank America Institute showed higher income Americans were spending at a solid pace, but those earning less are starting to tighten their belts, as you may expect. The Long Island Railroad, the nation's biggest commuter rail, faces a potential shutdown beginning Saturday. Talks between LIRR workers and MTA officials have hit a snag over wage increases, which is like the main snag. A strike would force thousands of commuters onto the island's already congested roadways. The economic impact of suspending service could amount to $70 million per day, according to one estimate. And Treasury Secretary Scott Bessent says the U.S. and China are discussing a, quote, board of investment to fast-track some non-sensitive Chinese investment deals. Let's talk about that right now with Bloomberg Treasury reporter Daniel Flatley out of Washington, D.C. So, Daniel, would this create some kind of pre-CFIUS fast lane, or how would these companies be classified as, like, low risk?
Yeah, it's a great question, Matt. I mean, we don't have a ton of details yet about how this would actually work, but essentially what you're saying is correct, as far as we understand it from what the Secretary said this morning, that there would be a board of investment. He's also talked about a board of trade with China that would wall off or sort of try to figure out a way to move some of these potentially investments from China through, or shepherd them through the CFIUS process, or perhaps even preempt the CFIUS process so they don't have to go through that. That's a little bit tricky politically. I mean, as you may recall, over the last several years, there's been a lot of concern about Chinese investment here in the United States, and Congress has been very active on this issue. So what this will actually look like, we'll have to wait and see, but it could be somewhat controversial.
I noticed actually in the Ford, there was an excellent story on Ford working with the Chinese battery company CATL, and in it there was a graph of Chinese investment in the U.S. We can see that it hit a high in 2016 when President Trump came into office and then just proceeded to dwindle away to nothing. Of course, this is, foreign direct investment. One of the things that President Trump has really been pushing for from other countries. Is this likely to boost that materially from China?
I think that is one potential outcome here. There's been several discussions over the last year or so behind the scenes about what China would have to do in order to bring the type of investments that other countries have, or I guess the way I should phrase it is, in order to make the type of investments that other countries have made in the United States. I think it's a bit of a higher bar for China, given all of the security concerns that have been raised, again, by members of Congress and others. But I think that, to your point, President Trump likes to see these deals. Secretary Bessent is there to facilitate the president's agenda. And so I think that this proposal is one among, I'm sure, some others that are being considered that would move that idea forward, where you would see some more Chinese investment here in the United States. But again, as you pointed out, there's been a sharp drop-off since President Trump's first term, and reversing that will be not an easy task.
We're just getting headlines that Elizabeth Warren is criticizing President Trump and Nvidia over the sales to China, or at least the approval of chip sales to China. And we see talk from the Treasury Secretary about tariff relief, about lower tariffs on purchases of U.S. energy and lower consumer goods. Is this a managed détente that we're seeing here, Daniel? Is the Trump administration trading away leverage for headline deals?
Yeah, it's a great question, Matt. I think that what you're seeing here is kind of the outcome of a summit or a meeting in which we weren't really sure what to expect, because the main thing, I think, for both parties is to keep the truce, the trade truce that was established last year, in place. Both sides have leverage in different ways. Certainly, we've seen on the Chinese side critical minerals and rare earths being a point of leverage that they have. They also, the Chinese side, want some things from the U.S., including purchases of airplanes and other things of that nature. So I do think that what you're seeing here is a little bit of both sides not exactly sure what they have to offer in terms of concrete deals. So they're putting forward some proposals, perhaps laying some groundwork for some additional things to come. But the most important thing, and I think the thing that markets are probably looking for more than anything, is just that this truce stays in place. And from what we've seen so far, that seems to be the case.
Well, it seems also like we're pushing for lower tariffs here, which is exactly the opposite of what President Trump says that he wants. So maybe they were just inflationary rather than strategic, or maybe we've gotten kind of a manufacturing influx that we wanted, and we're willing to accept that low-end consumer goods and like fireworks can be produced there, and we'll buy them cheap.
Yeah, I think, going back a year or so, there was a question that came up in a congressional hearing about baby products and things like car seats and consumer products of that nature. So, there's been kind of a longstanding desire to see some goods flowing from China to the U.S. More than others. But you raise an important point, which is, the Supreme Court declared invalid many of Trump's tariffs, including some of the ones that he imposed on China. Now, he has some more leeway with China because of some of the authorities that are already in place, but his firepower is a little bit more limited here. So this could be a little bit of sort of jujitsu in a way, where you're looking for some lower tariffs in order to facilitate trade, because you cannot necessarily or easily impose higher tariffs, at least in the near term. So it's kind of an interesting study in gamesmanship, what's happening here.
Yeah, no, it's nuanced, it's complex. That's what makes it fascinating, and you're so good at telling that story, so we really appreciate you joining us. Bloomberg's U.S. Treasury reporter Daniel Flatley talking about the potential for a board of investment. Speaking of boards, take a look at our dashboard here. The S&P 500 rallying another 0.7%, up to almost 7,500 right now on the S&P. The Nasdaq gaining to almost 29,600. This, as crude comes down, you can see Brent at 105, WTI is at 100, and you see massive gain in Nvidia, up 4%, as really the tech sector ex-China pushes markets higher. Coming up tomorrow, Samba Nova CEO Rodrigo Lang joins us to talk about Cerebras.